Good evening, everyone. Today is the evening of March 4th. Let's do a quick review of today's market action. I think today's move deserves some focus because many people might be wondering, didn't we say yesterday that the alert had not been lifted yet? Yesterday, we saw a series of very concerning technical signals. The three major US indices all broke into weaker territory. The Nasdaq moved into a clear weak zone. The S&P 500 dropped directly below its 150-day moving average, which is usually a very rational and important technical level. And the Dow Jones broke down from its bullish flag channel that had been forming during the uptrend. Overall, the signals yesterday were extremely ugly and honestly quite frightening from a technical perspective. But today, the market suddenly bounced back. So many people are asking, has market risk appetite suddenly changed? Let me first explain why the market went up today. The first reason is that the market digested the geopolitical tensions very quickly. There were two key developments. First, President Donald Trump stated that the United States would ensure the security of shipping through the Strait of Hormuz. Second, there were signals that Iran's new leadership is willing to enter dialogue. These two developments strengthened several expectations in the market. One, the conflict may end quickly. Two, global energy prices may not be significantly disrupted. Three, the geopolitical shock may be limited. The second major reason was economic data. Today, the U.S. released the February ADP employment report, which came in very strong at 63,000 jobs, the best reading in the past 3 months. Everyone knows that employment data is one of the most important indicators for Federal Reserve policy because the Fed has two core mandates: maximum employment and stable inflation. So this strong jobs number tells the market that even though inflation is not fully under control yet, the labor market remains very strong and the impact of AI on employment appears minimal for now. Because of that, investor confidence suddenly improved again. However, in my view, today's rally is more of a capital reallocation and positioning mismatch rather than any real improvement in fundamentals. So in my framework, remember this clearly. The market alert level is still at level 5. Why? Because today we saw another very important signal. One of the leading sectors today was a North American software ETF, which has already been rallying for several consecutive days. I saw a very interesting comment circulating in the market today. The popular explanation for the rally in US software stocks is this: the market expects the US government may move against Anthropic because recently the Pentagon reportedly threatened to place Anthropic on a blacklist. But here is the paradox. During the recent U.S. military strike against Iran, from target selection to overall operational planning to weapon selection and even execution timing, much of the process was reportedly assisted by Anthropic's cloud AI systems. So this creates a very strange situation. The U.S. government may want to blacklist the company, yet that same company helped the U.S. military carry out one of the most successful targeted operations in history. That is a highly paradoxical and almost absurd situation. And that's the first contradiction the market is facing right now. The second issue is this: the US government cannot realistically ban a software product that is already public, widely distributed, and partially open source. Think about it. Today, people around the world are already using cloud AI models everywhere. How would you possibly ban that globally? So the real threat to software stocks is not a specific company, not a single product, and not even cloud AI itself. It's also not specifically Anthropic. The real disruption comes from the AI agent paradigm. And I want to emphasize this very clearly. AI agents will eventually replace most existing subscription-based software companies. In the short term, AI may actually boost their revenues because these companies can integrate AI features and charge higher subscription fees. But in the long run, this entire model will be replaced. Right now, the reason it hasn't happened yet is simple. There is still no extremely easy to use AI agent that ordinary people can deploy locally. Today, if you want to configure something like OpenClaw locally for someone without a coding background, it is still very difficult. But in the future, there will definitely be a simple consumer-grade AI agent. Think about what Windows once did, how it dramatically improved the user interface and accessibility of computers. Eventually, there will be a similar breakthrough product for AI agents. And once that product appears, and someone will definitely build it, and in fact people are already trying, it could come from an American company or a Chinese company. Both are possible. Recently, we've already seen early experiments. For example, a company demonstrated a system where you can use voice commands to let AI order food for you. That may sound simple, but it is actually an early prototype of a household AI agent. In the future, this model could expand into many areas of daily life. You simply speak, and your AI agent could help you manage tasks at home, assist with work, shop for products, handle logistics, even help run a business. In other words, one AI agent could coordinate many parts of your life and productivity. And because of that, this model will inevitably replace a large portion of today's software ecosystem. So when we look at the current rally in software stocks, what does it really represent? It's essentially meaningless from a long-term perspective. This rebound is simply the market speculating on the AI narrative, rather than reflecting the true long-term direction of the AI industry. Now let's look at IGV again, but this time on the weekly chart. From the weekly perspective, the uptrend has already been completely broken. You might say, but it's still holding support here. Yes, it's holding for now, but the structure is already very weak. Why? Because this level has already been tested 3 times. In a strong bullish trend, price normally does not return to test the same level 3 times. A healthy uptrend should look like this. Price moves higher, higher lows keep forming, the structure keeps stepping upward, but here, that's not what we see. Instead of higher lows, the lows keep returning to the same level again and again. So the question is, why is the market repeatedly testing this exact level 3 times? That itself is already a warning sign of structural weakness. And this logic applies not only to individual software stocks, but also to software ETFs like IGV. The underlying technical structure is the same. So now let's go back to the overall market structure. First, let's return to the NASDAQ. Although the market went up today, we still saw weakness into the close. We mentioned yesterday that once the market showed that late session weakness, it quickly broke down from the neutral zone into the weak zone. Today, the NASDAQ moved back into the neutral range, but again, we saw momentum fading toward the end of the session. Because of that, in my view, when you see late session weakness at this level, there is a high probability that tomorrow the market will test the bottom of the neutral range. So the lower boundary of the neutral zone will likely be tested very soon. Now let's go back to what I think is the most representative index for rational market behavior, the S&P 500. As we mentioned earlier, the S&P 500 is a much better indicator of the overall market's rational structure. Yesterday, the S&P 500 clearly broke below the 150-day moving average, and importantly, it did not reclaim it by the close yesterday. Today, the situation is very subtle. It looks like it may have moved back above the 150-day moving average, but at the same time, it also looks like it didn't fully reclaim it. It's a very ambiguous and delicate position, but I want to emphasize something. Don't focus too much on the moving average itself. Yes, yesterday's break below the moving average was symbolic, but if you stare only at the moving average, you may miss the real structure of the market. At market tops, what you should actually watch is this. Are the highs getting lower and lower? If each new high is lower than the previous high, that structure forms what we call a descending triangle, or a downward consolidation pattern. Within that structure, there is a very important level. That level is yesterday's low. In my view, yesterday's low is now the key support level for the entire recent market structure. If the market breaks below that level, the current rally could end much earlier than most people expect. So yesterday's low is extremely important. What level is that? 6,710 points. 6,710 is a critical level, and in my opinion, the market will test that level very soon. Now let's also look at the Dow Jones. The Dow was actually even more dramatic yesterday. Remember, the Dow represents many traditional sectors such as industrial companies, consumer goods, and utilities. Yesterday, the Dow Jones directly broke below a bullish flag pattern that had been forming as a high-level consolidation within an uptrend. Technically speaking, this kind of breakdown is even uglier than simply breaking a moving average. If we look at the moving averages, we can see that from May, June last year until now, this is actually the second time the Dow has broken below the 150-day moving average. But the nature of this breakdown is different from the previous one. Pay attention to the difference. The previous breakdown was a slow drift below the moving average followed by a quick recovery. This time, however, it was a sharp breakdown followed by a sharp rebound. That kind of price action tells us something important. Market volatility and disagreement among investors are actually much stronger now than before. Many people say, do you even understand trading? If the market drops and then quickly rebounds like this, doesn't that show extremely strong buying pressure? My answer is no. After such a long period of consolidation at high levels, if the market breaks down and then immediately snaps back, it only proves one thing. Market disagreement is much more serious than most people think. What's actually happening right now is that large institutional capital is still adjusting positions. They are rebalancing portfolios, reallocating capital, building hedges, but they have not yet made a clear directional decision. And that directional decision will be very important in the future. So from my perspective, I cannot say that the market has already fully turned bearish. Yes, I am personally more cautious, but it's still too early to declare that the market has completely rolled over, just like the line we drew earlier on the S&P 500. If at this position, no matter how the market does it, as long as it takes back this line, then I can tell everyone the alert level would immediately drop from level 5 to level 2, or even level 1. At that point, the market would basically be safe again. It doesn't matter how the move happens. Whether it moves up like this or drops first and then comes back up like this, both are acceptable. The key point is simple. As long as this descending trend line is reclaimed, or even if the market takes back the previous lower high, the previous point, or this point, or if the market forms another pivot here at this point. As long as the price can take back these lower highs, then the downtrend ends and the market returns to an upward channel. But right now, and this is the key point, fundamentals do not support that scenario yet. The fundamentals simply do not support it at this moment. The war is not over, and the shadow of AI disruption is still hanging over the market. So for now, the conclusion remains the same as what I said yesterday. Cash is king. Focus on defense. Yesterday, we recommended Cal-Maine Foods, a very traditional food producer. Technically, it formed a very clean inverse head and shoulders pattern, a very classic inverse head and shoulders structure. This is a beautiful setup and relatively easy to trade. As long as the price breaks above this neckline, you can enter the position decisively. We also previously recommended Circle. Since our recommendation, it has already gained about 25%. If you follow this channel and build your individual stock positions accordingly, I believe your performance will already beat most investors. I won't claim you'll outperform 90% of the market, but at least 60% of investors. We've also repeatedly emphasized the importance of allocating to stocks like Tesla. Even though the price may look different in the short term, if you look at the daily or weekly chart, it is still forming a very clean consolidation at high levels. We also previously talked about Micron technology. As I mentioned before, its main hype cycle has already passed, but it can still be held as a small allocation within a portfolio. Right now, within the core AI sectors, which I previously categorized as memory, communications, computing, you should reduce exposure somewhat. But you shouldn't eliminate these positions entirely, because this AI megatrend may not be finished yet, and we don't know exactly when it will end. So the right approach is simply to reduce the allocation slightly, not abandon it. That's all for today's discussion. Personally, I think today's market action is quite subtle. Within this uncertainty, I still maintain a cautious, somewhat bearish view. However, in terms of portfolio positioning, you can still focus on defensive allocations. If you have better stock ideas, feel free to leave them in the comments. If there are specific stocks you want me to analyze, you can also let us know in the comments. And if you haven't subscribed to the channel yet, feel free to subscribe. See you tomorrow.